a tough space. But I mean, the sexy thing is it's cash, right?
Mm-hmm. Absolutely, yes.
That's the important thing. That's what we've got to focus on, is the cash that comes out of it, as opposed to the method on how we get there. Because, you know, property managers, some parts of that's not much fun either, I suppose. Not very sexy, ringing up tenants when they're not paying their rent, or, you know, landlords and asking for money to fix stuff. You know, not a lot of fun in that sometimes. Tough job, I reckon, sometimes.
Absolutely, yes. Speaking from experience, it certainly can have its tough days, but, you know, it's products and services that you offer that can certainly allow us to build better relationships and, you know, showcase to our clients that we're there to help them build wealth in their investments. So, yeah, I think if we can, you know, show we're an expert across different areas and not just that we can collect rent and type a tenancy agreement, yeah, I think that we can certainly improve those relationships with our customers.
Absolutely.
Yeah. All right. So we've got some of our participants who have joined in. So what we might do is get started, because we've got lots to get through today. So again, thank you so much. To all of the attendees, thank you for joining us on the webinar today. If you would like to ask any questions, please feel welcome to do so through the Q&A button at the bottom of your screen. And there's also a chat section as well. So if you've got any difficulties in hearing us or seeing us at any stage, please certainly do let me know. But we will get to Q&A at the end if we've got enough time. But I've got a lot of questions to ask this talented man. He's a wealth of knowledge. So I've got a list here to get through with him. So people don't know or have never had the opportunity to meet Brad Beer, gentleman today on our webinar, the CEO of BMT Tax Depreciation. So again, thank you, Brad, for dedicating your time, and of course to the industry as well.
Great to be here, Casey. Happy to run through, and hopefully we can all learn something, or some of you guys can learn something from this today. It'd be great.
Yeah, fantastic. So, Brad, I like to always, you know, get started with the webinar for you just to share a little bit about who Brad Beer is. And I know we've certainly seen you on the block, on the TV. So other than that person, who's Brad Beer? What's BMT Tax Depreciation all about?
Oh, couldn't I just run to be a film star? You know?
Absolutely, yeah, you can.
Look, I obviously run BMT, so I guess on me first. I grew up in a little country town called Taree, about 4 hours north of Sydney. Went through school up there. My parents still live there, one of 4 kids. Since then, went to uni, did a construction management or building degree after working in a furniture shop for a couple of years and realising that was a bit hard on my back, you know. Started at BMT second year into that degree, and that was in 1998. So I've been in June. In June it's 21 years. So I've been involved in it as a piece of the furniture. We're a little spare room business then. One of my partners was one of my lecturers, and they started BMT. I started working for them to get some work experience. I've been there for 21 years since I'm married. I've got 3 little kids now, and I love to, you know, get out amongst outside, and love to go boating and snowboarding, and not that I get much of that lately with children, but so love to fish and spend time in boats and on water wherever I can, and love to travel. Been around a bit of the world doing some of those things, and so that's been great. And BMT, I guess nearly 21 years of that. So obviously it's been a pretty integral part of my life. The business, after starting in 1997, me being there since obviously 98, started, you know, just doing some depreciation schedules, and we've organically grown that. There's about 220 staff in total. We eventually grew the business around the country over that period of time, and it's been a fantastic journey, and to see exactly see that from a little guy doing, or I'm a big guy, I'm 6'7", but doing a few depreciation schedules, coming out of a building or construction management degree, and then really learning how to run a business, and I guess then to grow a business. And I came a shareholder in the business in 2002, and I've been with a couple of partners, and now there's some more partners and things like that. But organically grown to where we've got to today, and it's been really good to learn about how to grow that business and some of the things that we and some of the things that we did and some of the things I learned over the way. I've been to probably more real estate conferences and training and then accounting ones as well than most real estate agents because of 20 years involvement, over 20 years involvement in this industry, and often as a sponsor at these things or a speaker on depreciation. I listened to lots of speakers on how to grow good businesses, read some books and as well, and try to apply some of those things back to our business. And some of those things work. You try, some of them don't. But as long as we're continuing in the quest, I guess, to learn to how to get our business better, which we still do. I've just been in a meeting today talking about some of the key reasons why we were successful, and are we still doing that? And it's a regular sort of discussion around on how we got to a position in our space like this, and how do we maintain to not if you're not growing, you're dying is something I believe in. So how do we maintain growth, even though our industry's had a few challenges over the last couple of years with legislation change, I'm sure we'll get into later. So a little bit of history there. I've had a lot of fun on the way.
Yeah, great. Well, thank you for sharing. I think it's just really important to, showcase a little about who you are and certainly the business, so that everyone gets a bit of a background story and understands the journey along the way. So let's dive right into it with my list of questions here, and I'm really excited to, have our attendees listen to what these answers are going to be. I think it's really important that we're able to showcase a different service offering, and that's where I believe property management is certainly moving towards. We've got to start thinking about it in a different way, and it's not just that we're there to collect the rent and do a routine inspection. So I'm really excited to hear what you've got to share with us today, Brad. So let's get into it. So my first question obviously is, what is depreciation? And why is it important for us as property managers or business development managers to showcase this as a benefit to the client?
So the what is depreciation, we'll try to keep that one pretty simple. And, things within an investment property wear out over time. Let's think of depreciation in relation to a car, because people understand that one pretty well. When you buy a car, you drive it out of the shop and it becomes worth less money, right? It depreciates in value. If you use that car for business, you get to claim some of that depreciation as a deduction because you lose value on that car, depending on what it is, quicker or slower. And you get to claim a tax deduction for that loss in value on the car. Just like when you have an investment property and you use that to gain income, which as an investment property, that's probably the important part of the next point. Use that to gain income. Your carpet's wearing out, your building's wearing out. Tax office allows you to make a deduction for the wear and tear of the items in the building, depending on ages and a few different things as to how much you can claim. But what it means is tax deductions. They're non-cash tax deductions is the important thing. They're a deduction that, when people know there's deductions in your property for interest and other expenses and related to that, repairs, maintenance and things like that, those things are things that you pay for and you make a deduction for, which is great. You get a deduction for that. But depreciation is a non-cash tax deduction. There's a mouthful. Yes. Non-cash deduction means I'm making a claim for the fact that my bricks and mortar are wearing out, right? Mm-hmm. What people don't sometimes understand is, but I want my property to go up in value, right? That's the idea of investing in property. And yes, look, the property and the value of the property goes up, but the condition of the carpet and the bricks wears out over time, and you're able to claim a deduction for that. So it's lucrative because what it means is a deduction for something you don't pay for. So therefore it means, which is what the whole point is, more cash in the investor's pocket. We've done research over time. 80% of people don't claim it properly, 70%, 80%, depending on what numbers you look at. But it's a lot of them that think it's looked after by someone else, think it's too old. I don't know what they think, but they come to us on a daily basis and we get them more money. And this is where, I guess, as a BDM or a property manager, every one of your clients is a property investor. They're not owner occupiers living in their house because they don't need your services, right? So every person that you're speaking to invests in property with the purpose of making money. They're there to make money in property. They're not there, they're there to provide housing for tenants and be nice to tenants, but there's still another reason. It is about making money from that property. They make money through a couple of ways, through growth in value of the property over time, through cash flow from rent that comes in from that property, but then they've got expenses to run that property. Then they make a part of that cash flow is around making sure they claim the proper tax deductions and use those tax deductions against cash flow to maximise the return on that property. Everything is about making money out of it and a return on that property. What we do is find tax deductions that are non-cash, and what depreciation is more money from that property. So as a property manager, if you want to, like we say, sign up tenants and collect rent only, that's great, etc. You need to do that. But knowing the things that help that client to maximise that investment is what's important in you being a standout property manager or BDM. When you get out to there and go, I know that this is important and people aren't taking advantage of their deductions properly, there's a bit more script and dialogue around that. But at the end of the day, what we do is get your client more money. And they're trying to mess you around on fees. They're trying not to spend money on stuff. And they're trying for you to get as much rent as possible, right? Mm-hmm. All these things are about money. We're just another piece of money, right? Basically. Yeah. Really simply.
Yeah, absolutely. So I think there's sometimes potentially a misconception, if I can call it that, about at what stage maybe the client could engage, obviously, in your services. And I suppose that leads me into the next question of, at what point in time is it good for the property manager or BDM to certainly talk about your services? For me, as a new client, I would certainly start the conversation at that appointment of, hey, let's look at this, or has your previous property manager spoken to you about this? But the misconception is that, maybe you can't get it on a new property, or maybe it's that you can't claim it if it's a really old one. So I know sometimes, it's been talked about in the industry around that. So can we maybe dive into that a little, Brad, about how we can start to introduce this into our services?
Yeah.
And when? Yeah.
Lots of jumping around questions in there, but let's try to address as many of them as we can. Now on the thought of when, okay, yes. Like a lot of people, so that we've got people that have just bought an investment property, and then they're going to try to make money from this property. You've got people that have owned it for a short period of time, people that have owned it for a long period of time, people that have lived in it and now moved out of it and it's become an investment property. The question of when is about, 70 or 80% of them aren't claiming it properly, maximising that deduction. So it's almost don't worry about when. It's let's go in as either BDM or the property manager, and some of our simple questions around, I'm here to maximise the rent. I've done the research. I think we can get this much. We've vetted the tenants. We can see the property's good or bad or whatever. You might need to spend some money. The dialogue or the start of this conversation is really simple. We here at XYZ Property Management understand that investing in property is there to make money, and we're going to do these things. But on top of that, do you know that depreciation means lots of money to people and they're not getting it properly? It's not very good dialogue there, but it's kind of the simplified version of depreciation is really important in making sure you get the most out of your property. I don't know everything about depreciation. I know a fair bit, but I'm the property manager here, or the BDM. I don't know everything about that, but I know that lots of people aren't claiming it properly. So what we do here at XYZ Property Management is to try to help you take advantage of those deductions properly so that you're getting the most out of this property and it's working as hard from a cash flow perspective as possible. If it's an existing client who owns one, they can actually go back for up to 2 years pretty easily and adjust their tax returns if they haven't been claiming it properly. Mm-hmm. So whether you're the BDM, the existing property manager, the new property manager has just taken over it, if they've owned it for a period of time, then there's an opportunity there to go, well, you know what, a lot of people aren't doing it properly. We can even fix some of the past. I don't know how, but let's see if we can work that out in the quantity surveyor. You just got to dump it back to the QS pretty quickly. Mm-hmm. Opening up the questions of there is cash in this, and you can go back a couple of years, I think, even if they've owned it for 4 years, 1 year, 5 years, whatever. You can go back a couple of years and we can go and see what they should be getting. Easily they can compare to what they are getting and say, I'm here to do that. Now, so on the when, that's probably the answer to the when. Now, what was the other part of the question? How do we,
and you probably did answer that in regards to the scripting there. It was, well, how do we start to introduce the dialogue around it when talking to the landlord.
Yeah, and look, the age was the other thing. Sorry, we'll get to
Yes.
the age in just a moment.
Yes.
Age doesn't matter as we get old. Anyway.
Yeah.
How do we start introducing that? You've got a lot of things to do. The thing is, we're talking about different places here. If you're a BDM, you might be at an appraisal. A property manager might be at an appraisal, or a property manager might be just talking to an existing client they've already got, right? Or they may already have them and they've just gotten them as a new client to deal with. But there's a lot of things you've got to deal with within these discussions. But somehow within that, the dialogue that's going in between is, when is the right opportunity for you to go, I'm here as your property manager and I'm really good at it, and our fees are this and et cetera, and I can definitely try to fill it as quick as possible, and I'm knowledgeable, but I know there's more cash in these things that people don't take advantage of, and it's through depreciation, and we can easily get some numbers on what that could be, and we can maybe move into how we get some of those numbers in a moment.
Mm-hmm.
But the important thing is just going, well, make it clear to this client that you know about something about investing. And that doesn't mean you need to know everything about, and depreciation is just one of these things. It's just one that means a lot of money, right? Mm-hmm. Insurances, smoke alarms, they're all important things, but we get money for them as quantity surveyors, as opposed to things that are necessary that don't necessarily show cash. Cash is going to ring with investors because they're only there for that reason. They're there to make money effectively. On the age of properties, there's going to be probably two pieces of question. If you have the opportunity at the right time and go, depreciation, you're getting all your money. Effectively, they might answer with one of a couple of things, and they might go, well, they might ask, oh, what is that about? Which sometimes. But a lot of the time people go, I've got an accountant that looks after my taxes. You're my property manager, right? Mm-hmm. So the accountant question is a simple one, in that the quantity surveyors work with the accountants. So accountants are our friends. We're not doing their job. They're not doing ours, or they might be trying to do ours sometimes, or making some guess, or who knows what, or just not doing anything, which is not doing theirs properly. It's not doing mine. We work alongside them. We're happy for clients to talk to their accountants on the way through the process. But your simple dialogue as a property manager around an accountant question is, oh yeah, I'm sure you've got a good accountant, but these guys work alongside an accountant to work out and make sure we maximise this piece, being the depreciation, and get as much as they can. Talk to your accountant before you do anything. Make sure you're getting the most out of it is what we're trying to do here, because 70 or 80% of people don't get all the money they could get out of that. Mm-hmm. And we can give the property manager some numbers to play with to have that discussion if they want to, or we can give it to the client later to go, you should be getting $8,000 and it looks like you're claiming 6. Maybe it's worth a discussion effectively, if it gets that far.
Yes.
Around the age of the property. Now, there's a lot of things that impact on how much you might be able to claim, and a lot of them do relate to age, or they relate to when you bought the property. But let's take it out and make it really simple for the property manager in this dialogue. And new property gets the most, right? So that if you're looking at someone who's got a new one, you can get a bit more excited about how much money's in a new one, right? But anything that's not new, it won't have as much as a new one, right? But let's not focus on how it doesn't have as much as something else. Let's focus on the fact that it still has money there.
Okay. Rather
than trying to work out as the property manager or as the client that's there talking to them whether there's much money there or how much it's going to be, it's you know what, depreciation is not taken advantage of properly. Old property doesn't get as many deductions, but it still gets deductions. Why don't we find out how many there is? And we can give the tool pretty easy to go, this is how much it is. You can get some money or not. And that doesn't cost anything. Mm-hmm. So the dialogue's really simply, people aren't taking advantage of it properly. Why don't we find out if you can get some more money? I don't know what landlord's going to say no to that. No, actually, no, I don't want to get more money.
Yes.
I don't want to see if I can get more money. But most of the time your answer to that's going to be, oh, well, unless they're dismissing you, which sometimes can happen, obviously. But the answer of, if you ask the question properly of whether you'd like to get more money out of this property and no, there's not a catch, should be answered with, well, I'm an investor. I'm after money. That's what I'm here for. So can I get some more money? Right. Mm-hmm. And maybe that leads us into the how we get those things,
yes.
I suppose. Do you have some question around that? Or?
Yeah, well, you did just mention about, a tool that you've got therefore property managers that can easily support this and help them answer some of these questions a little more maybe. So showcase or let us know what that is. How does it actually work? What is the tool?
Very easy, and we've got a tool to make it easy, but we can start with the concept, I suppose. And the concept is when you start having that discussion with a landlord and say, hi, we're doing a really good job and we're worth our fees and all that sort of stuff. And by the way, 70% of people aren't claiming depreciation properly. What if you went 70% of people aren't claiming, 80% of people aren't claiming depreciation properly? And Mrs. Jones, it appears based on what the coin surveyor says, you should be getting $6,500 to $7,500 per year. That kind of makes the discussion a little bit easier, doesn't it? Right?
Absolutely. And
rather than going, maybe there's some money there, it seems you should be getting around this much money is an easy discussion to have, right? Now that's really the simple concept, right? Because you should check that out with your accountant. I know you've probably got a good accountant, but maybe you should check out and making sure you get $6,500 to $7,000 because it's very easy for that person, the landlord, to go back and see their tax return. There's a little section that sees what they're claiming. If you've told them $6,500 to $7,500 and they're claiming $4,000, then I'll be asking my accountant a couple of questions. We're getting everything we can out of this. Now, the tool we've built to do that, we built something called My BMT, which is a portal which allows the clients to see their depreciation schedules, share them with their accountants. But one of the little things inside that is a thing called what we call new to rent. Now, new to rent is a name that, looks pretty rocket sciencey. When it's just been brought to rental, we get that data and see that. So if you've listed it up for rent, then we get the data on, one of the portals. We see that data, and then we run that through our system that runs an algorithm across that in depreciation land, because we've done 650,000 depreciation schedules, so we should get an idea of what they're going to come out at roughly. It runs through a system. It looks at the data we can buy and see, and if you've joined up to the new to rent system as a property manager or a BDM, as we see that listed for rent, then we see that it spits you out a little email, which is exactly those numbers we talked about, that says, hi, we don't know Mr. and Mrs. Jones that own this property. We know that the property's been listed for rent, and we can see what they've paid for it, when they bought it, photos of it because you put them there to make it look nice. System will go and actually generate this property should get around $6,500 to $7,500 per year as a tax deduction, or in the first year as a tax deduction, and spit you an email as the property manager that's got it on one page, right? And it doesn't say Mr. and Mrs. Jones. It says, hi, on 27 Smith Street, we believe the deduction should be X dollars, whatever it is. Let's say it's $6,500 to $7,500. So that can turn up automatically in your inbox as you list properties for rent, and we see them and see the data, up turns a little estimate. So all you need to do at that stage is, I was just thinking, like if it was done by email or by phone call, when that turns up, your non-proactive way would be to do nothing, I suppose, but your non-highly proactive way would still be to go, I just got this email from the quantity surveyor. I checked it out, Mr. and Mrs. Jones, and you should be getting around, seems, $6,500 to $7,500 a year as a deduction for depreciation. Were you aware of that? You really should check that with your accountant and see if you're getting all your money, right? Now, that is a really simple way you can do that inside the platform. See, I don't know something that you're going to an appraisal for, unfortunately. Well, you don't let that information out. So you might have to do some more work here. It's a little bit more work. Inside that platform in My BMT, you can enter into this thing in new to rent, the address of a property, and it'll do the same thing for you, providing we've got enough data to do that. Or if you don't want to use the online portal bits, whatever, you can also send Brad an email or one of the guys and say, hi, Brad, 27 Smith Street, I'm going to an appraisal today. Can you give me an idea of the numbers, right? It can be done a simple way if you don't want to do the automatic stuff and the online ones. And we can, once again, and this is still all free, we can give you the one page that says it should be getting approximately this much money. It's based on the actual address. It doesn't have Mr. and Mrs. Jones's name on it, but it has. So you go out to your appraisal. You're having a lot of discussion about how you're going to get the best rent and do a really great job and manage the property and you're worth your fees and all that sort of stuff. By the way, I took the liberty of asking the quantity surveyor about this depreciation because it's really important and you should be getting $6,500 to $7,500. You should speak to your accountant about that one. We know this is important because it's $6,500 to $7,500, right? So that is another simple way that you can use that. It is free for you as a property manager or BDM to go, let's get the numbers and let's just use them in our dialogue. And that's very simple. You've gone and given a landlord a thing that says they should be getting this much money. I'll be ringing my account for $6,500 deduction. We all look around for our dry cleaning receipts, right? And they're $100, $200, $300. How much for a year? $6,500. It's a phone call to my account to see I'm getting all my money out of my property. Mm-hmm. The important thing for you guys as property managers to make sure you keep that link to you. You were the one that introduced them to it. They got the money. Inside the online piece, you can see the ones that you have sent out. So inside my BMT, as a property manager with your login, you can see what you've sent out, when you sent it out. If we do a depreciation schedule for that client, you'll see that because we're going to call you for access because we need to get through the property. Then after that, you'd see we've done one. You don't see how much they got, but they should get what the estimate said, and that'll be a good time to make a phone call. Did you get that? Did you get some money? How good was that? How good was I? Sing your own praises every now and then. Maybe it's not quite that discussion having on the phone, but something along those lines that if you can connect yourself to that cash, it's probably more than you cost them in property management fees for the year anyway, and it keeps giving. It comes back again next year.
Absolutely. So, that was straight away what I was, thinking about as we go in, or even throughout that management term. We're talking about you've now got to spend this money. Oh, by the way, you've got to now spend this money, and by the way, you've got to spend money again.
I thought this was repeating accidentally.
Yeah. We don't have conversations about, oh my gosh, we could actually save you some money or get some more money in your back pocket. So we're talking about it being a proactive and a positive conversation with them, opposed to maybe it being negative, which in some cases it can certainly be in property management. So so where do they go to get the tools what's the website? Is there an app, Brad, or?
It's a website, My BMT, on the normal BMT website. If you just Google BMT, Brad Beer, whatever, you'll find that pretty easily. But the tool itself is something you need to log into, but you just create a login. It's really simple, and it's an easy. If you lose your login, you can get another one type setup. And then once, if the client's okay with, so we'll get the data of the things that you list whenever we see that, and they'll automatically turn up under your profile then as we produce these estimates for you. After that, if the client's okay with you seeing some of their stuff, I mean, the client can share their schedule with you on that if they want to, but they don't need to. But under it's My BMT is the website that you use to do it. One login, and then look, the same thing's used by accountants, so they can see all their clients' reports. Okay. So if an accountant's got 50 clients with BMT reports, the 50 are in there, and the accountant can see them all in the one place. You're just in a different section. There's a bit of stuff inside My BMT, but the new to rent is what you're looking for inside My BMT as a property manager for that automatic free estimating service.
Yeah, great. Excellent. And obviously tax time is fast approaching. We're halfway through April now. So, conversations like this is certainly important to start to have now. And what is the benefit in obviously having that conversation now in the lead up to June 30?
Well, there's a couple of things around doing it before June instead of after June. And the first one is, well, obviously there's a fee to our jobs, and it's $770 normally for a residential house or a unit. That's a tax deductible fee. It's 100% tax deductible. If you buy it off me in June, they get a tax deduction for this financial year. If you buy it off me in July, they get a tax deduction next July. Basically when they do, or next time they do a tax return. So if you're going to buy something for whatever price it is before the 30th of June or after the 30th of June, you should buy it before the 30th of June, generally if it's for your investment property or something that's investing. The other thing is you're allowed to go back for 2 years, as we discussed earlier, and amend some tax returns. So if this person's owned this property for 2 years now, and you told them about it after they did another tax return, there might be a year there that they won't actually be able to go back and get. So the longer they own it, the more of that they're potentially missing out on. And with such a large percentage of investors not doing it properly, you're sitting there with rent rolls of large numbers of clients that have just got money sitting there that's picking. So don't let them lose any more. I guess that's the question of, and they're thinking about tax. They're likely to talk to their accountant around tax time and actually try to pull their things together for tax. Anyone that's a tax planner starts thinking about tax before July and August when you get a group certificate, and property investors, hopefully that is the case.
Yeah, no, fantastic, excellent. And I know there's certainly been some changes. You did mention it earlier, and over the last few years, things have been challenging a little for the industry that you're in. So what are some of those changes that maybe property managers or BDMs should be aware of in case they get asked questions? And what I'm meaning is maybe some of those ATO laws or tax rulings that they might need to be aware of.
Look, the biggest change in the last couple of years has been one in the federal budget from 2016. Now, I almost don't want to confuse a property manager too much with it, but being aware that it's changed is probably the important thing. Now, what they've done there is, there's two parts of depreciation, one on the structure of the building and one on the carpet, hot water service and blinds and stove, right? And they've said that people bought after that date, regardless of age, don't get a claim against those things, the carpets, hot water services, etc. Now, let's step away, and there's white papers all over the place and plenty of analysis that could be done, but let's get it really simple, and let's go back to the age of the property question. So old property still gets depreciation deductions. It may not get as much, actually gets a little bit less if it's been affected by that budget change, but you're still covering it in the first statement. May not get as much, but let's see if we can get whatever money we can for you. The fact that that might be 7,000 instead of 9,000 or 6 instead of 8,000 now that that change has happened is irrelevant to the fact that if there's cash there, we want the cash. 6 or 8,000, whichever it is, I want it. What clients sometimes think is, isn't depreciation gone? Well, it is gone on that piece, but it's not gone on the other piece. So, and then as the property manager, your dialogue becomes a bit more like that. Yeah, there was some, what you need to know almost is that there was changes and it affect how much you might be able to claim, but there's still claims there. There's still potentially thousands that we might be missing out on. So why don't we go and see if we can get some money? You've got the automatic estimator or your, hi Brad, tell me about 27 Smith Street email for us to come up with what the numbers should be, which doesn't cost anything. So you can almost move around the real detail, because the real detail is quite painful and difficult, and legislation on tax, right? We're talking about sexy. That's not sexy. That's boring sort of stuff on what and whether, and you've got to almost get that discussion. If they've got detailed questions, you need to get that discussion to someone who knows how to answer them properly. If you really want to learn about them, you can read lots of great stuff, but not sexy. You're back to the core question of, I'm here to make that investment work as hard as it can for you. Let's see if we can get you some cash. Now, the things we'll talk to the clients about those. And one very key thing that we haven't touched on is before this change and after this change, we have a guarantee there that says if we think there's enough money in there to do a depreciation schedule, then we say, let's go ahead and do one, right? Then, I do have to charge people for something at some point, right?
Of course.
And if we tell them it's worth it because we've looked at the photos, we've done our little estimate, and we think there's going to be some money in there, then we should back ourselves, right? The guarantee is simple. If we can't get double the fee and deductions in the first full financial year, we cancel it, you don't have to pay for it, right? So we work out whether you're going to get some money first, or some deductions at least. Got no income, deductions are no good for you, right? But, property investors generally have some income. We'll work out if we can't get some deductions and we're wrong, then we'll wear it and your client won't pay any money. There's no use me doing jobs for people that don't get money for them, because that's what they're there to do. We identify that before we take any money from them. And if we get it wrong, I'll back it and give them the money back, because we should be able to back the work, and we've done enough of them to have a fair idea after a bit of a discussion with the client. But you don't want to get into that discussion as a property manager. You want to get into let's see if we can get you some money or not. And the quantity surveyor will be able to tell you that. And that's the really simple thing to keep remembering with any of these curly questions that the clients may throw at you thinking they already know it all, or the accountant does, right? They're all our friends. We give clients estimates. We talk to them about the thing and say, we're happy if you talk to your accountant. Your accountant will know BMT. Your accountant's probably seen the reports, unless the head's in the sand, because we've done lots of them for lots of investors. So they should understand the quantity surveyor's role in this, which is coming up with the numbers for this, and they're accepted by the ATO. Accountants don't do estimating the costs and come up with these numbers. Quantity surveyors or other cost professionals do.
Yeah, fantastic. And I know it's, I'm going to throw not a curly question, but just an edited one at the end if I can. Now you used to have an app. Now I don't know if you still do, but when I was property manager BDM in the industry and active, I would have your calculator app on my phone and used to utilize it for things like, insurance claims, or when I was potentially doing those vacates and the owner would say, no, I want the tenant to replace that.
Yes.
So then I would start to have those conversations around, well, of course, that carpet has depreciated, and when did we get it in, and all those things. So do you still have that app available to support property managers dialogue around those questions?
Absolutely. As you started talking there, I thought I was trying to work out which app you were talking about. I worked it out pretty quick.
Yeah.
We've built a number of apps that are quite handy for mostly for property investors, because that's at the end of the day the end client.
Mm-hmm.
But one of those is an app called Resi Rates, that's the one you're referring to. Now, for us to calculate the depreciation on an item, and let's take carpet because it's an easy example, the tax office actually puts what they call an effective life on that item. Mm-hmm. And with carpet, that's 10 years. Now, in total, outside of just property, there's about 6,000 items. So there's one on there also called, the name escapes me, that has all the 6,000. Mm-hmm. But the one called Resi Rates just has the 180 odd items that are in a residential property that can be depreciated, right? Mm-hmm. One of those is carpet that has a 10-year life. And what you're using it for there is usually when the tribunal looks at the value and the age of carpet, they actually use this tax effective life to calculate who should pay for what. So the simple, carpet has a 10-year life for depreciation. You're kind of claiming the value over 10 years. If the carpet's 5 years old and the tenant wrecks it, they use, carpet has a 10-year life, 10-year depreciable life. It's 5 years old. They'll do something like it's had half its life already, property investor. Tenant can pay half, you can pay half, or I don't know how the end tribunal goes. But it's the gauge that they use on the effective life of the item. And they're all inside that app. And as they update them, we update them. And it'll tell you what date is the latest date that works for it. But it's the same sort of mentality as to the age or the life of that's used by the tribunal. And, you're trialing through a bunch of ATO websites to find it otherwise. And we've just made it something that's very simple. And that's really an app that's mostly used by property managers.
Yeah, great. Yeah, I found it really useful through that vacate process. And if there was something, you could go on and actually check what is a lifespan and feel more confident in having the conversation with your owner to say, we're going to have to split the cost here, or no, we can't charge the whole replacement of that carpet to the tenant because of this reason. Here's why. And it just allows you to have a far better conversation and be more confident around it. So,
and it's not, it's not always the answer that the tribunal is going to give, but at least you've got some knowledge to say, well, look, this is the tax office rate. They'll end up using this. We could argue all day, but at the end of the day, we're probably going to get squashed based on what the numbers that are used at some point. So let's come to an agreement and make it easy.
Yeah, absolutely. Great. Well, I'm going to see if anyone of our audience here, Brad, has got any questions at all. If you do and have questions for Brad, please note them down in your chat section there of the webinar page, and we can certainly forward those on to Brad. I'll ask him now if you do have any, if there's something specific you'd like him to retouch on or share anything with you. Again, please do let us know. And we can also, I'll send everyone through the website link, Brad, the name of that app and things so people can log in and create your own account and start to give this positive information to our clients and customers.
Happy to, I'll get that sent through, Casey. That's probably the easiest way. We're trying
to absolutely.
We'll give you a little way to navigate to it that's easy.
Yeah, perfect. Excellent. Well, no one's got any questions. I think it's because you gave them so much information. And, as I said, tax depreciation, it's not a sexy topic. But if we can talk about it, as you shared, of saying, well, I can help you get some more cash in your back pocket. than that. So if there's, any of that extra dialogue at all, please feel welcome to connect with me, and certainly do send an email. I'm more than happy to then forward that on to Brad and the team at BMT if there's anything that they can certainly help you with. Actually, hang on. We do have a question. They're not leaving us yet.
Okay.
First question. Thanks, Harry, for sending it through. It says, what happens if the estimate comes through incorrect?
Well, we've built the algorithms around the estimate so that they shouldn't come in incorrect. If we don't have enough information around the property, we don't automatically spit out an estimate. So if there's not enough information from the data sources that we buy, because sometimes that's the case, then it says a refer or or it comes up with a zero number or a talk to us type setup, and then. We sometimes you need a human to interact because we've got eyes and we can make decisions, and sometimes specialists in knowing that, as opposed to the computer generating as much data as it can and coming up with a number. If it comes in incorrect, which the guys have done tolerances on them. If anything, we put a range on it, so we'll be inside that range. And they've done some numbers on it, 90-something% of the time, right? Mm-hmm. If it comes in incorrect from the initial estimate to then when we have a discussion with that client, still before we go ahead and charge them any money and do anything, we'd identify, I think, from a bit of a look at it with an eye, that look, okay, the estimates come out at $8,000. From looking at it, we think that could be a bit of a struggle. It might be more like $6,000. Do you want to go ahead and do it for $6,000 as an amount to claim? But we'd identify the way through. Look, if the client doesn't want to go ahead and do a depreciation schedule because they don't think the numbers were quite the same, then we won't do it, right? Like, they can pull out at any time unless, we've really delivered on what we say we were going to deliver on. Then I'll say, well, you should get it. Go and get your $6,000. That's still good, right? Yeah. But they've done the tolerances pretty close, so they're providing that information, because if we don't have enough, it just doesn't come up with a number automatically, and we need to look at it to come up with those numbers.
Mm-hmm. Correct. We have another question.
We want to make sure it's right on the time.
Yeah. We've got another question from Rod, which is actually a great question to ask, is what are the proposed changes to the depreciation schedule if Labor gets into the federal election?
Yeah, good question. The answer is there's no proposed changes to the depreciation schedule. That's great. The Libs already did that to me in 2016. They changed the rules and meant that the investors get a little bit less out of that. There's no changes to the depreciation rules under what they're proposing. What they're proposing is a change to capital gains tax, which is kind of different to what we're talking about here. But the proposed changes to negative gearing mean that someone who buys a second-hand property won't be able to claim negative gearing against their other income, or claim their losses against their other income from an investment property. Now, what does that mean from a depreciation point? Well, we still do the same job. It's just some people may not be able to use those deductions as much because they might already be in negative territory. Some of them are in positive territory from their rental and other incomes to start with, and depreciation might bring them back to either zero or into negative territory, and they won't be able to write off these deductions against their other income. So that's not necessarily, I mean, the answer is nothing to depreciation. What will be the effect afterwards, I guess, is the question. And one thing in the detail of the proposed legislation change that they don't have yet is, so what happens to those losses now? Do they get quarantined? And from some of their stuff in the past, I think in 2016 in that election, they talked about quarantining those losses and using those against future capital gains. But I think they've actually taken the policy off their website in the last couple of days because they've been attacked pretty hard on the way they've come up with the numbers, being that they think that investors are all buying second-hand properties. I think they said 96%, then 93%, then 86%. Industry says 45% or 55%. So I think the policy is gone. It also just doesn't have enough detail about what will happen to those losses, whether they're quarantined and be able to use in the future or what, right? So the thing is, depreciation on a property that is positively geared, you'll be paying tax on your rental income if you don't claim those deductions. If it's positively geared by more than depreciation, we may create some more deductions, and then you still want those pieces of the deductions. It's there's no change in depreciation. It's just about how effective it's going to be, and then we don't even know the detail of how it's effective, what it could be used in for the future. So we need some more detail on the policy to be able to really answer that very, very well.
Yeah, yeah. No, but I think it's certainly a good question because with the election coming up, you never know what changes they're going to bring into place, really.
There's not a lot of detail provided. I think is the final answer. There's a lot of detail on some things. Even with that depreciation legislation change, there's a big it's not even very clear on how the items that you can no longer claim under the new depreciation legislation should be treated at the point of sale in regards to capital gains tax. The industry doesn't understand it very well. Our tax lawyers that we've had to come in and make sure we build the reports properly versus what the Australian Point Surveyors say. And so it's actually been quite confusing for the end user on how that will be treated. We've built our reports the right way, we believe, and that we've built it so that they can use what they need to use. But some of the legislation that they've written on the CGT there doesn't actually make a lot of sense. Mm-hmm. And the ATO is actually reviewing at the moment because my guys have been talking to them about that review on the way they've written that and what their actual intention was in the first place. And this is the coalition, not the future. Yeah. So a bit of a mess the way it's turned out.
Yeah. Yeah. Have we got any other questions at all for any of our attendees? Please do write them in there before I send this wonderful man to get to his next meeting, no doubt. I'm sure that you've got a busy afternoon, Brad.
I do. It's all right.
Yeah. It's been an absolute pleasure having you and, just being able to really dive in and getting some more information on those questions. They're things that as a, consultant to the industry, I need to know as well to be able to help the businesses that I'm working with and just different dialogue that they can be talking to their clients and customers about. So again, thank you very, very much for dedicating your time to us.
It's great to be here.
And please do send those links through if that's okay, and I'll share them with everyone so they can sign up to my BMT and to start getting those estimates in for their clients.
Great. Excellent. Yeah. Thank you.
Yeah, great. Good afternoon.
Thank you.